Welcome to Family Business Breakthroughs, where we bring you time-saving, money-making strategies to improve your business even more. With over 3 decades of experience serving multi-generational family businesses, we've got time-tested solutions that get you the results you're looking for. Listen in and get ready for your next breakthrough. Today, we're talking about something every business owner thinks about: profit. Not just revenue or sales, not just we had a good month, but the real question: how much profit should your business actually be producing? Because here's the truth: family businesses are working harder, they're selling more, staying busy, and still leaving profit on the table. Not because they're careless or bad operators. It's not that they don't care. A lot of the time, they simply don't have the right financial visibility. They know what is in the bank, if sales are up or down, if payroll feels heavy or repairs and maintenance feel expensive. They know insurance keeps climbing, which does, but they may not know how those numbers compare to where they should be. And that is where a profit opportunity analysis can become incredibly valuable. So, most business owners want to know one thing: am I doing a good job compared to my peers? And that's a fair question, because when you own and run a business, especially a family business, it can feel like you're operating in a vacuum. You see your numbers every month, you see your own expenses, you see your own challenges, the team issues that are there. But what you often do not see is how your business compares to others like you. And without that comparison, it's hard to know what your numbers are really telling you. For example, your repair and maintenance expenses may feel high, but is it actually high? Your payroll may feel heavy, but is it out of line compared to similar businesses? Or maybe your gross margin may be declining, but is this something that's happening industry wide? Is it a trend? Or is it just something that's happening inside your company? Your revenue may be growing, but are your expenses growing even faster? That is the type of clarity owners need, because the financials are not just the reports for your accountant or the bank, they're a scoreboard. And when you read them correctly, they can show you where the business is strong, where it's drifting, or where hidden profit may be sitting. So, a profit opportunity analysis is a deep dive into the financial performance of your business. The purpose is not simply to look at whether the company has made money or lost money, but to answer deeper questions like: where is the business trending? Where are expenses creeping up? Where is the company overspending or underspending? Where are margins getting squeezed? And where is the hidden profit sitting inside the business? And then finally, how does the company compare to relevant benchmarks, right? Benchmarking is very important because a number by itself does not always tell the full story. Let's say a company spends $250,000 a year on repairs and maintenance. Well, is that good? Is it bad? It depends. And compared to what? To revenue, gallons, vehicles, locations, similar companies? And how has it been going over the past 3 years? That is where the analysis becomes powerful, right? So the goal is to turn financial data into insight, not just here are the numbers, but instead, here is what your numbers are saying. And even more importantly, here's what you need to do next. You need action. So, one of the biggest mistakes that owners can make is looking at a 1 year in isolation. 1 year does matter. Of course, it does. But trends tell the story. A single year could be impacted by unusual events, maybe losing a big customer, hiring decisions, weather, fuel prices, insurance changes, market shifts. We haven't seen any of those, right? But when you look across 3 years, patterns start to appear. You may see revenue growing, gross profit shrinking, payroll increasing faster than sales. You may see operating expenses slowly creeping up over the year. You may see a department that looks profitable on the surface, but actually is creating margin pressure. You may see that the business is producing more volume, but not more bottom line profit. And the last one is very painful, right? Because no owner wants to be working harder for the same amount of money, right? It just doesn't make sense. That is one of the biggest reasons this analysis matters. A company can grow and still become less efficient. A company can look busy and still become weaker financially. That is why trend analysis is so important. It helps separate motion from progress. So, when most people hear financial analysis, they immediately think the goal is to find where the company is spending too much. Yes, that is part of it. But a good profit opportunity analysis should also look for areas where the company may be underspending. That might sound strange, but it matters. Sometimes a business is overspending in one area because it's underspending in another. For example, a company may be spending too much on overtime because it's underinvested in staffing, training, scheduling, or even systems. A company may be spending too much on repairs because it is underinvested in preventative maintenance. A company may have weak margins because it has underinvested in pricing strategy, sales training, financial reporting. And a company may have too many inefficiencies because it is underinvested in leadership development, accountability, documented processes. So the goal is not simply to say cut expenses. That can be dangerous. The better question is this expense producing the right return? Because some expenses are a waste, some expenses are investments, some expenses are warning signs. But a profit opportunity analysis helps identify the difference. Most owners already have a feeling for the business, right? They know when something feels off. You got that gut feeling. They know when the team is stretched, cash feels tight. They know when a department is not running smoothly. But instinct can only take you so far. The financials either confirm that instinct or challenge. For example, an owner might say, I think labor is our biggest issue. But after reviewing financials, the real issue might be margin erosion. Or they may say, we have a sales problem, but the numbers may show they actually have an expense control problem. Or they may say, we need more revenue, but the analysis may reveal they could create meaningful profit by tightening areas already inside the business. That is a powerful concept. It changes the conversation. Instead of guessing, the owner can now make decisions based on facts. And that is what good financial analysis should do. It should reveal blind spots and it should help the owner prioritize what matters most. And let's talk about benchmarks really quick. So, benchmarks are valuable because they create perspective. Most owners are not looking for perfection. What they're looking for is clarity. Are we in line? Are we behind? Are we ahead? Where are we stronger than others? Where are we weaker than we thought? And sometimes benchmarks can be encouraging, right? It's not all bad news. An owner may think they are doing poorly in an area only to discover they are actually outperforming every other company. That matters because not every number needs to be fixed. Sometimes the analysis tells you what to leave alone. Other times it tells you where to focus. You may be saying if your insurance expense is far above the benchmark, that's worth reviewing. Okay? If your payroll is moving in the wrong direction without the right return, that is worth discussing. Benchmarks do not make the decisions for you, but they help you ask better questions. And better questions usually lead to better decisions. Sometimes you might hear us talk about hidden profit. We are not talking about the magic wand, right? Or a secret pile of money sitting on the corner of your office, though that would be nice. Hidden profit is usually found in small areas that have slowly become normal. Margin leaks, expense creep, a process that takes too many people, a vendor cost that's not been reviewed, inefficiencies within the business, a pricing model that's not kept up with the cost increases. Individually, these may not seem dramatic, but together they can become very expensive. That is why a business owner can look at the P&L and say, we're profitable. But the better question is, are we as profitable as we should be? That's the opportunity because a business does not have to be broken to be improved. A profitable business can still have hidden profit. A growing business can still have waste. A successful business can still be underperforming compared to its potential. Now, there's also an emotional side to this, right? For family business owners, the business is personal. It represents years of sacrifice. It represents the family name. It represents employees, customers, community, and legacy. So when people start digging into financials, it can be vulnerable. Nobody wants to be judged. Nobody wants to hear you're not doing this right. That is not the point of the profit opportunity analysis. The point is not judgment. The point is clarity. It is to help the owner see what they may not be able to see while they're buried in the day to day. Because when you're inside the business every day, it's hard to step back and see the full picture. What are you doing on a daily basis? Answering calls, solving problems, managing people, dealing with customers, putting out fires, making decisions, all while this is happening, the numbers are telling the story, right? Question is whether anyone is slowing down long enough to read it. So, a strong profit opportunity analysis should give an owner several things. First, it should give them clarity on trends, not just what happened last year, but what has been happening over time. Second, it should give them comparison to benchmarks. That way, they can see where they stand against relevant peer expectations. Third, it should identify areas of concern. These may be expenses that are too high, margins that are too low, trends moving in the wrong direction. And fourth, it should reveal areas of opportunity, right? This is where the business may be able to improve profit, strengthen cash flow, make better operational decisions. And fifth, it should lead to action. This is the most important part because analysis without action is just information. The value comes from what the owner does with it. The best decisions or the best business owners do not just look at financials just, once a year, right? When taxes are due. They use financial information as a management tool. They use it to make better decisions. Should we hire? Should we raise prices? Should we cut this expense? Should we invest in this equipment, change vendors, restructure roles, focus on a specific department, pull back from a low margin area, double down on what is working? These are leadership decisions. And leadership decisions are stronger when they are supported by financial insight. That is why the profit opportunity analysis is not just an accounting exercise, it's a leadership tool. It helps owners move from, I think this is the problem, right? To the numbers are showing us really where to focus. The shift matters. This type of analysis is especially valuable for owners who feel like the business is successful, but still not producing the profit they expected. It's for the owner who says, we are busy, but where's the money going? It's for the owner who says, our sales are up, but cash still feels tight. It's for the owner who says, I know there is waste somewhere, but I don't know exactly where. Or I want to know how we compare to others. Or I do not just want reports, I want insight. This is the difference. Reports tell you what happened, insight helps you decide what to do next. At Meridian, we believe family businesses are worth protecting. But protecting a business does not only mean succession planning, leadership development, or preparing the next generation. It also means protecting profitability because profit gives a business options. It allows you to invest in people, improve systems, right? Weather difficult seasons, grow intentionally, build transferable value, create a stronger future for your family and your team. Without profit, everything gets harder. With stronger profit, the business has more choices. And that is why the analysis matters. It's not just about staring at spreadsheets, though I love to do that. It is about helping owners see the business more clearly so they can lead it more confidently. So here's the question I want to leave you with today. Ready? Do you know where your business is leaking profit? Not where you think it is, not where you feel it is, but where the numbers actually show it. Second question, do you know how your business compares to peers? Because without that perspective, it's hard to know whether you are ahead, behind, or simply guessing. A profit opportunity analysis gives you a clearer picture of your trends, benchmarks, spending patterns, and your hidden opportunities. And sometimes the most valuable profit in your business is not found by selling more. Sometimes it's found by finally seeing what has been sitting in the numbers all along. So, thank you for listening to Family Business Breakthroughs. If this episode made you think of your own financials, your own expenses, your own unanswered questions, that may be the exact place to start, because clarity creates confidence.